leading indicators. And if you turn to page 10, the very first chart I put together, so this is almost 30 years ago now. I want to say it's late 90s. Pretty simple. And it's going to be the same formula over and over and over again. Change in the Fed funds rate, inverted, advanced 18 months. And you can see it back to 1975. Is it off in some cycles? Yes. It's not going to be perfect at inflection points. It's the trends that are ultimately going to be the most helpful, because some of these lasted for 2, 3, 4, 5 years. And so understanding, there's a relationship between how long the Fed eased policy or tightened policy and how long leading indicators, ultimately saw their trend last. So this is the very first one I put together. And it's pretty clear that Fed policy helps you understand, the future trajectory of interest of leading indicators like the ISM new orders. That means that anything that looks like the Fed funds rate, you can use to try to garner insight on the future. So if you look at page 11, here is the Fed funds rate with the slope of the yield curve. We have mathematically inverted it just to show, that Fed easing usually means a steepening yield curve. Fed tightening usually means a flattening yield curve. But since we know that we can use the Fed funds rate to forecast leading indicators, well, surely we'll be able to do the same with the slope of the yield curve or anything that looks like Fed policy or even that is an input into it, core inflation and the unemployment rate. So that's, I referred to it here on the chart as the cost of money proxy, but all things that correlate with the Fed funds rate are going to be helpful in this regard. We have 30 of these tools that we use to forecast the PMIs. You don't need to have 30. Remember, I'm a sell side analyst. I publish every week and I have to reinvent the same message using different tools. And so I'll publish, if the trend is up and I know it's going to last for another year, I'm going to be talking about it every single week to get people to understand that the trend's not over. It's probably not ending until roughly this time period. That's how these tools are helpful at the end of the day. All right, on page 12, we saw this chart earlier, but this is where I talk about inputs into policy. So inflation is part of the Fed's reaction function. Core PCE, more specifically, is the series that the Fed is supposed to be anchored to. And of course, labor markets. So you're going to find a lot of gauges of labor markets, a lot of different versions of inflation that will be helpful at forecasting leading indicators. All right, and here's how these things fit together. Look at page 13. This one I really like. Here's short rates with the prices, so short rates year over year, with the prices paid series from the ISM survey. So this is the inflation proxy that comes out in the ISM each month. It's not part of the index calculation, but I would argue it's probably the most important series from that release each month. Pretty easy to see here that, well, when the prices paid index is moving higher, generally there's upward pressure on short rates, and where the series ends is in 2021. Some of you might recall that at the time, inflationary pressures like this were telling you there was a problem, but the Fed was, viewed it as transitory. And so in this case, did a good job at communicating that, because short rates didn't budge a whole lot. And then in 2022, the Fed had to raise rates aggressively, having misread the situation. But that's the link between gauges of inflation and interest rates. If you look at page 14, again, I tend to be ISM centric. You don't need to do that. You just need to find a couple leading indicators that you're very comfortable with and that become part of your toolkit. And then you try to understand where they're going. And that's going to be the same recipe, different versions of interest rates on the left, inverted advanced 18 months, different versions of inflation on the right. So this is pretty cool because what we're doing here is we're using the prices paid series from the Philly Fed survey. We're inverting it, advancing it 18 months, and you see how it gives us a heads up on where the Philly Fed is going. So again, goes back to my earlier comment that this is often, the very most important part of the PMI release is the early stages of the supply chain when it comes to inflation. They refer to it as prices paid. All right, let me go to page 16 and just wrap up the uh, stuff on AEIs, anticipatory economic indicators. Number one, Fed policy is the ultimate starting point of the business cycle. That is almost always true. Anticipatory economic indicators are a critical tool in market forecasting, well, because they allow us to understand leading indicators, and that's what financial markets are. Interest rates can predict the timing and magnitude of changes in the economy. Yes, it's never going to be accurate to the month. In the full MSD program, we talk about what to do when you know there's an inflection point coming. There are ways to, there's different strategies that you can use. Some people just, we built this tool that we call the neutral portfolio, which is a way to negate the business cycle completely because you're waiting for things to turn and it can be off by a month or two on either side. And so you don't want to be pro-cyclical too early. You don't want to be pro-defensive too late. There's ways to position yourself around that. I feel like point number 4 is the same one as point number 1, the importance of monetary policy in consumer-driven economies more specifically. Number 5, interest rates and inflation are both anticipatory economic indicators. Recall the chart of ISM prices paid and the change in 2-year rates. And there are many ways to measure monetary tightening without using interest rates. In other words, you can build anticipatory economic indicators without necessarily using bond yields or the Fed funds rate. There's inflation, there's proxies of labor markets, there's all sorts of tools that can be helpful. All right, so that's the lesson on AEIs. And again, you don't need to do things exactly as we're doing it. We're trying to give you the concept. I think everybody should have a couple leading indicators that they should focus on. I'm very partial to the ISM, as you can probably tell by now. I do think that it is the best data point out there. Philly Fed, would be second on my list. And then find a few AEIs that you can use that becomes your toolkit. Understand that what we do and the way you're going to apply these tools will be different. I publish on the sell side at the end of the day, where repeating the same message over and over again is important. It's not the same thing as investing. All right, so